Hello guys, welcome back to my channel. Today we are going to talk about 401A versus 401K. What's the difference? 401A versus 403K, an overview. The two primary types of defined contribution retirement saving plans offered by employment are 401K and 401A plans. They take their names from Section 401 of the United States Internal Revenue Code, which defines them. The principal differences between a 401A plan and a 401K plan are first in the types of employers that offer them, and then in several critical provisions regarding contributions and investment choice. 401A plan is generally offered by government agencies, educational institutions, and non-profit organizations rather than by corporations. These plans are usually custom designed and can be offered to key employees as an added incentive to stay with the organization. The employer usually sets the employee contribution amounts, and the employer is also required to contribute the plan. Contributions can be either pre or post tax. Because the sponsoring employer establishes the contribution and vesting schedules in 401A, these plans can be set up in ways that encourage employees to stay. Employees' participation is often mandatory. If employees leave, they can usually withdraw their vested money by rolling it over into another qualified retirement savings plan or purchasing an annuity. The employer of determines the plan's investor choices and tends to be limited government sponsored 401 in particular may include only the safest, most conservative investment options. 401k private sector employees usually offer a 401k plan. A traditional 401k allows employees to contribute pre-tax dollars from their paycheck to the account and take a tax deduction from their contributions. The employer sponsoring the 400k can select which investment plan will be available for participants. However, as a function of their fiduciary duty, they need to be careful to offer a broader range of options than the sponsors of 401A plans often do. Plan typically offer 15 to 30 investment options, though research has indicated that too many choices confuse participants. However, with the Secure Act of 2019, employees may find more annuity plans offered as investment options in their 401k plans. The Secure Act now protects employees from being sued should be annuity insurer fail to make annuity payments to the plan participants. Assets in a 401k plan occur on a tax deferred basis, and in the case of traditional 401ks are taxed as regular income. When they are withdrawn, withdrawals from a Roth 401k are generally tax free. Key differences: the main difference between 401k and 401A plans in the type of job that they offer them and whether or not there are contribution requirements if you work for a non-profit or government job. You will likely have a 401A plan as a part of your benefits package. The government and non-profit organizations that offer 401A plans that makes it mandatory for the employees to enroll and contribute an amount set by the employer. If you work for a for-profit company that has a 401k retirement plan available, they can choose whether or not you want to enroll and you can set your contributions. The tax rules may differ between the two plans. If you have a 401A, your employer may structure your plan's contributions as either after tax or pre tax dollars. It will depend on the employer you work for because the employers, not the employees, structure the way taxes are handled with the 401A. Pre tax means contributions are not taxed at the time of investment, but later upon withdrawal after tax means contributions are taxed before being deposited in the account. A 401k is a tax deferred retirement plan, and usually your contributions come directly out of your pre tax paycheck. You pay income taxes on your withdrawal after you retire at your ordinary tax rate. What happens to my 401a when I quit? There are several options for your 400k if you leave your job. You may be able to leave it in the account, roll it over for, or an IRA, or you can cash it out if you chooses to do this. You will pay 100%. You will pay a 10% out of 100% penalty on the withdrawal, plus owe taxes on the funds based on your tax bracket. Is it better to contribute to a 401k or a both 401k? Whether one is better than the other is up to an individual situation. The difference between 401k and Roth 401k is how accounts are taxed. If you contribute to a 401k, you benefit from not being taxed on the amount because it is pre-taxed income. If you contribute to a Roth 401k, you pay with the after-tax income, meaning you don't get the tax advantage. However, when it comes to retiring with a 401k account, you must pay taxes on your withdrawals, but no taxes are owed on funds coming out of a Roth 401k if you have the account for 5 years or longer. Can you take money out of a 401a? Yes, you can take your money out of a 401a, but similar to a 401k, if you make withdrawals before age 59 and a half, you will have to pay a 10% penalty. In addition, any funds you remove from your 401k will be treated as income and you will owe both federal and state taxes on it. Compete risk free with 100,000 in virtual cash. So, this is it for today, guys. For 401A versus 401K, what's the difference topic? If you want a part 2, please tell me in the comments below. I will see you in the next video. Thanks for watching.